I don't know how many calls you've been fielding since last night or now. You've got a big gain in the stock market. We just showed the Dow is now up by 728. What's your advice to people right now?
Well, take a deep breath, first of all. And I think the key with the election was the Senate, and that was the fulcrum position. But we have a base case that looks forward into Q3, Q4 of 21, and we're skating to where that puck will be. Specifically, we think there'll be a vaccine in Q1, a fiscal stim in Q1. The vaccine will get distributed in Q2, and both the fiscal stim and the vaccine will have an impact in Q3 and 4, meaning that the U.S. economy in 21 will underperform expectations, and it won't be until 22 that we get back to pre-COVID levels of about 160 in earnings on the S&P. So our game plan remains the same. We're overweight growth versus value. We're overweight U.S. versus non-U.S. stocks. And we have no emerging market exposure right now. And we're going to keep it that way.
All right. Joe Terranova, what is the market reflecting here today? Is it trying to sniff out a Biden presidency and the Republicans keeping control of the Senate? Because there's a lot out there, OK? You've got the undecided map. You've got the president flooding the zone with all sorts of doubt and fog, including a number of tweets this morning following those comments that he made about 2:30 in the morning this morning, I guess it was. So what do you make of that?
What I make of it is that markets are getting a scenario that's a very favorable one for risk assets. The potential for a higher tax consequence for individuals and corporations, the likelihood of that is dramatically lower. The potential for a tighter regulatory environment is dramatically lower. And the potential for the reintroduction of globalization, which would potentially remove some of the tariffs, if not potentially eliminate all of them. So these are three positive conditions that are being placed into the market, in addition to the global liquidity that currently exists. And I think the right move for investors is to continue to be invested and do it in a way that expects lower yields to continue to dominate the taxable fixed income environment.
Kerry, the move that we're looking at it right now on our screen as Joe was talking, plus 471 in the NASDAQ, a gain of better than 4%. You could weigh in on that.
Yeah. Yeah, well, it just shows that this rally we've had over the last few weeks that was very favorable towards cyclicals and value, that trade was a little premature. And we saw the NASDAQ and the top of the tech valuation group come down, Apple, Facebook, Amazon, et cetera, with the belief that there would be a big stimulus package and we would start to see the value stocks move higher. Well, that trade now is reversed. Today, you're seeing a big move of technology, the big digital platform companies, the same names that brought us the rally through the first 8 months of 2020 have come back roaring because of some of what Joe said, less regulation, tax rates not moving. We still have COVID. We're still in an environment where remote and distance type companies, the COVID plus names, are still going to carry the game for the next 2 quarters at least, maybe 3, maybe 4. And so that's what you've got to own. And if you were to look at just what's happened in the market recently and why it's reversing today, we've got a little chart. Can we just show it? That shows how mid-cap, equal weight S&P has trounced the QQQs, meaning the NASDAQ and the S&P, since the end of September. They've had a big rally in those value names, and that today is what we're seeing, a reversal, because there was too much pull forward of that trade. People are going back to the playbook of what brought them here, and I think we believe that that's the trade that's going to continue through the rest of this year.
Yeah. Jim Lebenthal, the market probably believes that some sort of stimulus would happen. If Biden's in the White House, McConnell, the majority leader, as of this moment, Senate's still very much in the balance, but he has signaled already this morning that he would like to do something. The question is going to be, the size of whatever plan can come forward. But I'm looking at a stock like Caterpillar today, for example, Jim, down 5%. I'm betting if there was a blue wave, Jim, Caterpillar would be up 5%, not down 5%.
Yeah, I think that's fair to say, Scott. And, as Kerry was just saying, Caterpillar is emblematic of this reversal of what we've seen over the past several weeks where cyclicals have led growth. Now, the question is, obviously, whether we get stimulus, how much of it, but where do we go from here in terms of the markets overall and value versus growth? I want to make a very strong point, okay? If you were in Caterpillar because you felt that the next year or 2 or 3 were good prospectively for it, today is not a day to throw in the towel. And I want to give you one solid piece of evidence for that. If we went back 2 weeks ago and I told you, Scott, or you told me that today we would have an undecided election, it would be coming down to the mail-in ballots, which are going to be counted, and the president is putting out what you rightly call fog, I would not tell you, nor would you tell me, that today we're going to be up 3% on the S&P 500. That just does not compute. And what it tells you is you should not be trying to trade these events even if you think you know the outcome. What you should be doing is taking a stock like Caterpillar and saying, if I look forward 6-9 months from now, hopefully we have a vaccine, but more likely we do have fiscal stimulus and its infrastructure spending, which will benefit Caterpillar. So today is definitely annoying, but doesn't throw me from my thesis on Caterpillar or having a balanced growth and value portfolio.